Hello and welcome to Survey of Accounting. By way of starting this course, I thought what I'd do is just cover the basic tenets of accounting, just some basic information. As you go through the chapter and read the first chapter of the course, you'll kind of get this filled in for you, but I want to go through a basic outline, things that you should know about accounting and the importance of accounting, and then we'll get into something I think you can carry with you throughout the rest of the course. So when we talk about the importance of accounting, we're talking about why do we do accounting or why do we have accounting. And basically, accounting and the associated reports that you'll be studying really helps to identify the records, also it communicates information, and also provides a written verification of what the company has done or what a business has done over a period of time. And that information that it communicates has got to be relevant. That is, it has to be meaningful to make a decision meaningful. It also has to be reliable, something that people could depend upon, and it also has to be comparable from period to period. Well, the question arises, who uses accounting information? And typically there are two groups of users, external users and internal users. When we think of internal users, we think of folks within a company or within a business, and here on the slide you see a list of those individuals. External users could be many. It could range from regulators to creditors to investors in the company, a whole slew of individuals that could have an interest in the business. And so the reason we generate accounting information and then subsequent accounting statements, basically for these two user groups. The accounting industry follows something called generally accepted accounting principles, and in your reading you may see it listed as such or abbreviated as GAAP, G-A-A-P. And GAAP basically forms, if you're looking at thinking about building a house, what's the first thing you do? You set up a foundation. And that foundation from an accounting perspective is GAAP. And so notice what it does. It utilizes some of the basic tenets we've already discussed: relevant information, reliable information, comparable information over periods of time. So it has those basic tenets as its building structure, if you will. Where does GAAP come from? It just doesn't come out of the air. Well, basically, GAAP is promulgated or established by something or a group called the Financial Accounting Standards Board, sometimes referred to as FASB. And this is a group of individuals who relies upon not only input from the accounting industry, but from private accounting firms, public accounting firms, academics, users of accounting information before they establish any standards. We're self-governed in the perspective of FASB issues these standards that we're required to follow. If for whatever reason there's a lapse in following that requirement or those requirements as set by FASB, the SEC, the Securities and Exchange Commission, can step in and regulate accounting. Now, very rarely does that happen. The only time, or the most recent time, where they stepped in and at least had something to say was during, many of you may have heard of this, the Enron crisis, where Enron was providing false information, false reports to the general public. And so the SEC didn't particularly care for that. They stepped in, they had a few things to say, but ordinarily the SEC will allow the accounting industry to regulate itself. And the way it does it is by following the standards as set forth by FASB. When you talk about international, we utilize GAAP under the premise of FASB in this country. In other countries, they use the International Accounting Standards Board, IASB, which is the, I guess, the cousin, if you will, international cousin of FASB. And they use the reports on an international basis. Instead of using GAAP, they follow their own. So that's basically what we do from the perspective of governing ourselves in the United States. What are some of the basic principles of accounting that we use that form the basis of GAAP? Well, you see on the slide in front of you various principles, and I'm not going to go over all of these. You could take your time and go through as many of these and pause it and see what they have to say. I'll just hit a couple of these, one being a going concern. Obviously, when a company or business establishes itself, its intent is not to go out of business anytime soon, but to keep on going for as long as they can. Take Coca-Cola, for instance. They've been a business, a company for over 150 years. Matching principles, whereas you're going to find we try to match the revenues and the expenses that generated those revenues in the same accounting period. And so these form the basis of accounting, generally accepted accounting principles, and what we utilize as the standards, if you will, of enforcing or ensuring that we follow accounting practices, good accounting practices. There are different forms of business entities that use accounting information and accounting reports, and again, you'll be reading about these in detail as you go through the book. Sole proprietorship, partnership, and corporation. For the most part, we're going to focus on corporations and some of the things that they do. But we'll also look briefly at sole proprietorships. For instance, if you wanted to establish your own business, you can. There are some intricacies associated with sole proprietorship in that, for instance, you have full liability. So if something happens to the business, guess what? It's on you. Partnership, depending upon the kind of partnership that you engage in, you could have a general liability partnership where everybody has a certain amount of liability that they have to share. You could have limited liability partnerships. And so there are different kinds of partnerships that you can engage in. From a corporation standpoint, your liability as an investor, as a stockholder, is limited typically to whatever you invest in the business. And so when you look at liability incurrence, it really goes from sole proprietorship being the most to corporations being the least. But there are other features of these business entities that we'll get into as well. Okay, what you see in front of you is something you're going to become very familiar with, at least hopefully through the rest of the course, but specifically in these first few chapters. And it's called the accounting equation. And as you can see, an equation has an equal sign in it, which means something on the left side of that equal sign has to equal something on the right side. And in this case, the assets will always have to equal the liabilities plus equity. Equity may be referred to as owner's equity or stockholder's equity, depending upon whatever form you see it in. Just understand that they're the same thing. And we're going to go into a little bit of a discussion of what each of these represents. But again, notice the balance, that these have to be in balance as we kind of go through our discussion and later on talk about accounting transactions and ultimately financial reports. Okay, so the first part of the accounting equation on the left side of it are assets. What are assets? Basically, assets are things a business owns. You have assets, companies have assets, any type of business entity will have assets. And here you see a general list of some of the more prominent ones. Cash being the most liquid. Everything basically is convertible at some point into cash. And then you see these other items. And again, as we go through the material and through the course, you're going to get a more broad definition of each one of these. But for the time being, just understand that assets in these various kinds that you see here are things that a company owns and typically controls. Liabilities, on the other hand, are things that companies or individuals owe. Just like you may have a mortgage payment or credit card payments outstanding that you need to pay, those are liabilities. And so corporations, businesses will have liabilities as well. And what's a common thing that you see here in this slide regarding liabilities? Notice the word that always shows up in every one of these prominent liabilities. It's payable. Anytime you see the term payable, that's going to indicate something that a business owes. Therefore, it's going to be regarded as liability. So basically, liabilities are claims against the assets of a business, and those claims against the assets we generally refer to as liabilities. Equity is the last component of the accounting equation. So we started with assets, and we said assets equal liabilities plus equity. Now, you may see or hear me refer to equity as owner's equity, or you may read about it as being stockholder's equity. Just understand they're all one and the same. And what this represents is the ownership in the business by the owners of the company. Well, who are the owners of the company? Stockholders. So to that extent, equity or owner's equity consists of two major components: contributed capital or stock and retained earnings. Retained earnings are, well, I guess putting it as briefly as I can, as understandably as I can, they're like the savings of a company. And so think about you personally. You bring home a check, you have revenue for a period of, let's say, a month, and then you pay your expenses. You may have something left over. To the extent that you put it into a savings account, that's retained in your savings account. Businesses do the same thing. They don't call it savings, though, they call it retained earnings. And so the profits, the retained earnings, if you will, of a company, who do they belong to? The owners. And so the owners contribute capital through common stock. They could get it back, sell their stock anytime they like. Retained earnings becomes the privilege and the ownership of the owners, the stockholders of the company. How do they typically get it? Through the payment of dividends. And so what you find is these two groups, stock and retained earnings, which comprises stockholders or owners' equity, belongs to the owners. How do they get this back? Well, they could sell the stock and get their money back. They could get the retained earnings from the company declaring dividends. So that's how equity works. That's what it relates to, and that's who owns it. So we come back around to the accounting equation, and now you know what the assets are, the liabilities are, and owner's equity components are. So here's just another pictorial of it. And this kind of breaks out the equity section in a little more detail. Notice what I said earlier. Basically, owner's equity is comprised of stock, in this case, common stock. But as we get in and talk a little more detail about owner's equity, you're going to see that there's a thing called preferred stock as well. But I don't want to get ahead of myself. And so stock and retained earnings are the components comprising equity. And what goes into retained earnings? Remember I said it's like savings. And so it's going to be the revenues that a company takes in for a period of time, less any expenses, giving them net income, less any dividends that they pay out of retained earnings during the period of time. This is an equation, and these are the components of this equation that you'll get very familiar with and you'll work with and set the basis for analyzing transactions and ultimately putting together financial reports as we go on.